annual report. And so what's the example about? The first, you can see the reference of the example is from the paper I sent you, labor market benefit of this disaggregated disclosure. You can see the example from the paper, and we will have a presentation on this in a more detailed way. But I want to go over this with you in a quickly way. You can get an idea. So let's look at this. So what's this about? So for example, let's say Fiat hired a CEO in 1996. You guys know what Fiat is, right? It's a small car, very tiny car. It's like smart. It's a compact car. So we have Intuit hired Steven in 2000. Have you guys know the company Intuit? You guys know about that? It's a software company, provide business solutions, like they help you to file tax. They help you to understand your wealth. It's like a personal finance, like a retail financing company, provide like a platform and techniques. And we have different companies. So you see, these companies are hiring these CEOs in different years. So one thing, what the test, what we are doing here is, can companies actually more efficiently hire CEOs based on the CEO company's annual report? That's the idea. So for example, Intuit hired Stephen in 2000. So the story, what we're doing is, can Intuit understand the Stephen's performance better by looking at Stephen's annual report in the past years. So for example, Fiat hired Paolo. When Fiat hired Paolo, can Fiat actually analyze the Paolo's past annual reports? By analyzing Paolo's past annual reports, they can understand the Paolo it's a good firm for Fiat, so they can hire them in a more efficient way. So that's the example. Second example, what we are talking about, how exactly firm can analyze annual reports for corporate hiring decisions. And this is important. This is, CEO, they are not just they're not just common employee, right? The firm strategy, operations, financial condition, the decisions related to that are made by CEOs. So you got to hire right CEO for the firm. That's how you can keep the firm grow health. So that's the idea. This is very important stuff when you hire CEOs. So how exactly Fiat can analyze Paolo's past annual report and understand Paolo is the person for the firm? Exactly like you guys, when you guys get a job, how the firm analyze your CV, past CV. By analyzing your CVs, they can know you are the right person for the firm. So for example, they analyze like Sumin's CV. They say, oh, Sumin, yeah, okay, this is the lady we want, right? They analyze the Wei Qing. They say, oh, wait, they look at the Wei Qing's CV. So the idea here is the similar. So how the hiring firms can analyze the candidate's annual report in order to understand the candidates, it's a fit candidate for the firm. Okay, so exactly how we do the analytics. So this is the example you can see from Google. So Google's annual report. So what does this mean? You can see what? you can see what information. So in this report, you can see where's the profit from for Google. So Google have different business. Google have a website. Google have a network members website. Google has other revenues. So Google has different revenue from different business lines. So for example, the search engine generates revenue for Google. And also Google has members, network members website. Basically, they can, they have different another business to generate profit. Google has other revenues. You guys know, in the 2013, Google start cloud computing. This is just 2013, 2014, 15. Right now, this cloud computing is huge for Google. So what does that mean? That means Google can gain money, can make a profit from different sections. Google can make money from website. Google can make money from the network business. Google can make money from cloud computing, blah, blah, blah. So this is what you can see from annual report, So when you evaluate the Google CEO, you can evaluate, is the CEO good at manage a website, or the CEO good at manage the network members, or the CEO is good at the cloud computing. So by looking at the disaggregated segment sales and revenue, you can evaluate the Google CEO's personal strength in each directions. So for example, I give you my CV. My CV has breakdown like what? Breakdown has research, teaching, and service. So you can evaluate me. You say, oh, hey, Sean, your research is good. Your teaching is good. Your service is good. Everything is good. All different way. You can say, oh, Sean, your research is okay. It's okay. Your teaching is pretty good. Your service. So by looking at the breakdown, of the segment revenue, you can evaluate whether CEO has strength in the website business, or have strength in the network business, or strength in the computing business. You can evaluate the CEO in the different sectors. So the interesting stuff is this kind of breakdown is not always available. This kind of breakdown is only available since 1998 in the US. So basically, the idea here is before the 1998, the company only report a very rough segment revenue, or one single number of the revenue. After 1998, the company has to report a detailed disaggregated revenue from each segment. So the idea here is we want to test whether this disaggregated reporting of the segment revenue will help firms to find a better CEO for them, because before 1998, companies only know the CEO's general performance. They only know Sean is good at managing the firm. That's before 1998. After 1998, they know Sean is good at managing websites, not good at the network, and also I'm good at managing computing business. So basically, the idea here is before the 1998, because the annual report only reports aggregate performance for the CEO, the firm, the hiring firm only can get the CEO's overall performance. But after 1998, the firm can see the CEO's disaggregated performance in each business, in a website business, network business, cloud computing business. By looking at the information, can actually hiring firms find a better CEO, more fitted CEO by looking at the segment performance of the CEO. That's the analytics we're testing. So the message we're trying to send in here is the annual report not just helping the investors make decisions. You see the examples we're talking about earlier. Annual reports can help investors to make decisions. Annual reports can also help other firms to make decisions. For example, here, the hiring firm can look at the CEO's annual report. By looking at the CEO's annual report, the hiring firm can decide whether the CEO is a fit CEO or not fit CEO. That's the idea. That's the idea. So one more time, important. The annual report, not just for the use of the annual report, not just helping investors making trading decisions. The annual report can also help other firms to make a lot of decisions, not just hiring decisions, maybe cash flow management decisions, leverage decisions. It can help corporate to make decisions as well. That's the idea we want to present it here. We want to present it here. So let's look at the setting. Let's look at the setting. How exactly the setting has been tested. So let's look at it. This is 1997. Before 1997. Just look at it. You can forget about this great area. Just forget about the blue area. So before the 1997 company report the segment in a very rough way. So basically they don't separate the segment, even if they separate segment very rough way. So before the 1997, you only know the CEO's performance in a very general way, not in a detailed way, general way. So after 1997, what do you know? You know the CEO's performance in each of the 5 segments. You know their performance in the cloud computing. You know the CEO's performance in the network, CEO's performance in the website. So basically that's the idea. Before 2007, hiring firm only know the CEO's general performance. After 1997, the hiring firm know the CEO's performance in each segment. What we compare is, do firms can find better CEO? Do firm can hire fitted CEO after the 1996 by analyzing the CEO's annual report? By analyze the CEO's annual report, and you do the comparison before and post, and you don't worry about the controls. Control is control for something else. I don't want to make things too complicated. You can read the paper. You can read the paper why we need control firms. But the idea here is when you know the CEO's 5 separated segment performance, would that help hiring firms to find a more suitable CEO? That's the idea compared to the pre-1997, and we found yes. When you know more about the CEO's segment performance, the firms can find more suitable CEO. So that's the idea. That's the idea behind. So let's look at the results. So so basically, you can read the paper to see what does these numbers mean. But let me just briefly go over the idea here. So basically, you look at this interaction, the post. Post means after 1997. Pre means before 1997. The treatment means treatment group and control group. So what does this number mean? This number means after the hiring firm know about the CEO's performance, after the after 2000 after 1990 after 1996. So after 1996, after the hiring firms know about CEO's segment operating performance, the hired CEO can help the firm generate more earnings in the future. So that's one results. That's one thing. One results we talk about here, and this is one results. Another results what we have is after the 1997, 1996. So when hiring firms know more about the candidate CEO's segment performance, the hired CEO will stay longer for the firm. So basically, before 1997, when hiring firms do not know about the CEO's each segment performance, the CEO will stay with the firm shorter. But once the hiring firm know more about the firm's the candidate CEO's segment performance, the hired CEO will stay longer in the hiring firms. That's the idea. So let's just still take me as the example. So what do you mean by this results looks like? So basically before 1997, my CV only say I'm a great person. Before 1997, my CV is I'm a great person. After 1997, my CV says I'm good at research. I'm not good at teaching. I'm good at the service. So after 1997, so basically, if you hire me before 1997, I can generate less earnings. I will stay shorter in the hiring firm because there's no fit between you and me. You can, if you only look at my rough CV. But after 1997, if you hire me, I will generate more earnings for you. Because when you're looking for candidates, you have more information to evaluate the candidates. You know the candidates, whether the candidate is good at the cloud computing or the Google or the sales or the website or network. And also I will stay longer after 1996 because you know my CV, you know I fit, I'm suitable for the company. So I'm willing to stay in the company longer after you see I'm a good fit. So basically, that's the idea. That's the idea for the second example of the annual report. The idea here is twofold. There are two folds for the idea. The first is the peer firms. The peer firms can learn about the candidate CEO's annual report. If the peer firms, if the hiring firms know more about the candidate's CEO's detailed segment performance, they can find more suitable CEO. And the CEO will stay longer in the hiring firm. The CEO can generate more profit for the firm. However, before 1996, when there's no such information available, the hiring firms, when they hire CEO, the CEO will stay shorter, have a shorter tenure in the firm and generate less profit. So the idea here is the disaggregated segment performance about the firm helps the hiring firm to locate more suitable CEO. So that means annual report is helpful not just for investors. Annual report also is helpful for hiring firms to identify ideal CEOs to make a better decisions. And hiring CEO is very important. Hiring CEO is very important. So that's the idea. That's the second example about here. The hiring firms can actually looking at the annual report of the candidate CEO by identify they are fitted CEO or not fitted CEO by looking at the disaggregated segment performance. And the annual report can help both investors and managers to make decisions. So that's the idea. That's the idea of the second example. It's a little bit different from the first example we talked about in the class, but yeah, that's the idea. So you guys should be able to understand how we use the annual report for the corporate hiring decisions. And also you should understand the structure of the annual report. How is the report disaggregated? And you can see the CEO's single performance. And what's the question we examined here? And what's the result we found here? And you can also remember, this is just for hiring decision. The annual report can also help corporate to make other decisions like CSR decisions, like for example, cash flow management decisions, for example, leverage decisions, for example, investment decisions. So the idea here is the annual report not just helping corporate to make hiring, the annual report not just helping corporate to make better hiring decisions. The annual report can also help other corporates to make better investment decisions, CSR decisions, cash flow decisions, leverage decisions, a lot of decisions. So it's very, very important to be able to analyze annual report. As finance and accounting students, analyzing annual report is critical. It's critical because annual report is very, very fundamental data resource for you. You should understand what is item 1, what is item 7, what is item 1A. And that's number 1. You have to understand the nature of this stuff. And the second is how you use this data to analyze to get the decision support. So we talk about the first example, we talk about second example. In the second example, we teach you guys how to analyze the annual report to help corporate to make better hiring decisions. And then you can also analyze the annual report to help firms to make better cash flow decisions. You can think about different ways. You can think about different ways to analyze annual report. So that's the second example about annual report analytics we are talking about today.